Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Well, this week, records for U.S. stocks, inflation prints, too. One that caused investors to more definitively price in a Fed rate cut in September. And then a second one that dialed those expectations back. And then, yes, of course, geopolitics, including a meeting between President Trump and Russian President Vladimir Putin. And Bloomberg News breaking the story late Thursday that the Trump administration is in talks with Intel to take a stake in the company in what would be a huge push to boost domestic chip-making manufacturing. This is all according to people familiar with the plan. For the latest on this Bloomberg exclusive, head to the Bloomberg and to Bloomberg.com. You'll also find there the cover story of the upcoming Bloomberg Businessweek issue, which is particularly prescient. More on that in a moment.
Plus, retail with Dana Telsey and concerns about critical minerals with the head of a mining company. Also an AI surge for Bloom Energy, both of those stocks soaring this year. Later on, we're going to head to the Pebble Beach Concours d'Elegance. All of that to come. We begin with this week's release of the cover story in the upcoming new issue of Bloomberg Businessweek. It features U.S. Treasury Secretary Scott Bessent, who talked to Bloomberg Treasury reporter Dan Flatley and Bloomberg's Eric Schatzker about growing up in South Carolina, working for George Soros and Stanley Druckenmiller, and his path to the Trump White House, and to not being head of the Fed. Our interview with both reporters can be found on our podcast feed.
Well, after the cover story was published, the Treasury Secretary stopped by Bloomberg headquarters and studios this past week, joining Surveillance's Jonathan Ferro and Anne-Marie Hordern to talk about everything, chips, government data. He also suggested the Federal Reserve's benchmark ought to be at least 150 basis points lower than it is right now.
What if the BLS data had been the higher quality and we'd had those numbers, Jonathan? So if we'd seen those numbers in May, in June, I suspect we could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. And I think President Trump is very good at giving these nicknames. And I think the reason that the Jay Powell gets the nickname too late is because he wants to go into a series of rate hikes. He's not willing. He's not Alan Greenspan, who was very forward thinking. They try to be more data driven, which I think is a mistake, because I think we are going back into an economy like we had in the 90s. So, it's just very old fashioned thinking. But I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September.
A 50 basis rate cut in September. Does that signal that the economy, though, is not doing well? That signals that there's an adjustment and the rates are too constrictive. If you look at any model, that we should probably be 150, 175 basis points lower. So I think the committee needs to step back. I think probably one of the most politicized governors just went off the board, and that she was very, very political, I believe.
That was U.S. Treasury Secretary Scott Bessent with Bloomberg's Jonathan Ferro and Anne-Marie Hordern this past week. That complete conversation, they covered a lot. You can find it online at Bloomberg.com and on the Bloomberg terminal.
As we mentioned earlier, Eric Schatzker, Bloomberg New Economy editorial director and editor-at-large at Bloomberg Businessweek, was one of the co-authors of the Businessweek cover story on Secretary Bessent. So we asked Eric, along with Bloomberg International Economics and Policy correspondent Michael McKee, to do a debrief with us following Secretary Bessent's Bloomberg TV and radio interview.
Well, first and foremost, he is speaking on behalf of the president and trying to drive his agenda. That is his job and the job of every cabinet secretary working for President Trump. In theory, it's the job of every cabinet secretary working for any president. But there has, it would appear, been room for a little more debate and disagreement in previous cabinets than there is in this cabinet. So that's number one, right? It's a salesmanship job. He's out there advancing president's objectives, president's policies. And as we've seen, he's also a tool, if you will, for the president's negotiating style, or even the manner in which he shapes public opinion, which is to drive people to extremes and then ultimately pull them back a little bit.
That was a big takeaway that I had, Eric, from the cover story that you wrote with Dan, was the risk tolerance for President Trump and the way that the Treasury Secretary talked about President Trump's risk tolerance with regard to
being higher than his,
a hedge fund manager who spent years taking on big bets, working with George Soros and others. And that's the whole idea behind the tariff negotiating strategy.
To a degree, sure. There are clearly differences in the way you manage risk as a hedge fund manager who has a fiduciary obligation to clients, and the way you think about risk and reward and making bets on outcomes as the president of the United States or as a policymaker in cabinet. And there's no doubt that in Scott Bessent's mind, Donald Trump has a higher risk tolerance, but it's a risk tolerance, again, I don't want to put words in his mouth, but as explained to us with a purpose. In other words, let's see how far I can push people so I know where their limits are, and then I can pull it back to something that they're comfortable with, but only comfortable with because they felt what it was like to be scared.
So is he taking a risk, Mike? I want to bring into what he said. He talked about the Fed working off of data that's not of higher quality. Is he taking a risk in that I don't know what he's looking for. Like, we all think the U.S. data, the world thinks the U.S. data is the gold standard.
Until Friday, we thought that. Now the narrative is that, wait, this data is lumpy. This data is not good.
Right.
It needs to be paused.
He's saying we should have had then cuts in June and July.
Which is the other Trump thing, is throw so much stuff out there that you confuse people and you get people to think that the truth is not the truth. These are the gold standard data around the world, and while they are somewhat less scientifically valid than they were because the response rates have gone down, they are still extraordinarily accurate. Revisions are a part of it. So this is, it's truly an effort. The whole BLS firing thing is an effort to confuse Americans about what's going on with the data, so that when the data look bad, Trump can blame the data rather than his policies. So for Scott Bessent, he has to go along with that. But what he wants from the Fed doesn't comport with the way the Fed is looking at it.
He also made reference to Alan Greenspan. He said he's not willing, meaning Fed Chair Jay Powell, he's not Alan Greenspan, who is very forward-thinking. They're trying to be more data-driven, which I think is a mistake, because I think we are going back into an economy like we had in the 90s. We heard that. Mike first, and then Eric. We've all been around since Greenspan, all of us. There's a lot been written about perhaps the actions that Alan Greenspan took as Fed chair in the lead up to the great financial crisis, the mortgage meltdown. Is that a good reference point, Mike, for the U.S. Treasury
Well, it's
Secretary?
an interesting question. I don't think most people listening these days anymore really remember a whole lot about the Greenspan years or Greenspan's role in it, other than those of us who were very closely tied to it. But he did, in the 1990s, suggest that inflation was going to be low because productivity was picking up because of personal computers. And that was the thing that got him the fame and the lionization in Washington and on Wall Street. And then, of course, he had the oops of, no, there's not going to be a housing crisis. And so, I don't know if it's a good comparison or not. The one thing you can say is that Greenspan, unlike his successors, was very forceful and basically kind of ran the Fed in the direction that he wanted it to go, which is not something that Jay Powell does, and it wasn't the way Ben Bernanke or Janet Yellen are.
Eric, are you, given the reporting that you and Dan Flatley did, the folks that you spoke to within the Treasury Secretary's orbit, they seem to express a little surprise that he has not just joined the Trump administration, but that his views seem so in line with the president's views right now. How do you explain that?
In two ways. The first is there's no question that Scott Bessent's point of view and the things that he says to back it up have evolved over the course of the past, at the very least, 7 months since he became Treasury Secretary, and even before that. As of last year, I remember interviewing him a little more than a year ago, and he was talking then about the sense or sensibility of a 10% global tariff. And he was also then talking about the goal of getting debt to GDP ratio down, as far as the federal debt is concerned, and also the percentage of, the size of the deficit, the annual deficit relative to GDP, as a goal of under 3% and by the end of the president's term. The fiscal discipline has sort of gone out the window for the time being with the One Big Beautiful Bill. Besant will tell you that if the bill is successful, and he believes it will be, in deregulating the American industry and thus supercharging some kind of domestic manufacturing renaissance, then you'll get a change in the relationship between the numerator and the denominator. And in fact, yes, deficits will start to fall as a percentage of GDP over time. So he hasn't totally walked that back. On the subject of tariffs, he now talks about how the president's maximum pressure strategy is what has allowed the United States to achieve these deals on paper with countries like Japan, for example, and South Korea and others. And we'll see if those terms stick and exactly how these novel terms unfold in the way of real substantive agreements. But, and again, this is not to sort of come out in his defense. That's not our job. But I would point out that at the moment, the global tariff rate is 14%. Right? It's not that far off of 10%. I mean, 4 percentage points is 40% higher than 10%, but it's not 25% and it's not 39%, which is, of course, what the Swiss appear to be headed for at the moment. So it's shifted, but it hasn't shifted to an extreme place, if that makes any sense. Does that help to answer the question?
It does.
And of course, and I would just say that, yes, the reason that people around Scott Besant are surprised by the fact that he has come out, that he's in the administration and that he went out for President Trump in the first place on the campaign trail and fundraising for him, is because they thought that he was a little closer to who they think of themselves as, which is a Reagan Republican. And the truth of the matter, as we demonstrate in our reporting, is that even over the past 10 or 15 years, he has held different points of view. He just hasn't shared them with everybody.
We're speaking right now with Bloomberg New Economy editorial director and editor-at-large of Bloomberg Businessweek, Eric Schatzker, along with Bloomberg Businessweek, or Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee.
Speaking of productivity, just a quick headline. Apple planning to come back in artificial intelligence with new devices, including robots, a smart speaker with a display, and home security cameras, according to folks in the know. This may be a little bit of what some say, maybe...
Does it do the dishes?
Not yet.
But it will be an AI Fed chair.
But exactly. Well,
Shadow AI Fed chair.
Okay, we only have a few minutes left here. And I guess every time I listen to Scott Besant, I think about someone who understands the importance of an independent Fed, understands the role of the U.S. central bank in the world. Do you feel like, Mike, that he understands that, and that if it gets a bit wonky or gets very political, that there will be market implications, not just U.S. market implications, but global market implications?
Well, I think Besant knows that very well. I mean, he's not dumb.
But is he a guardrail around the president with that?
Well, no, there are no guardrails around this president anymore. He can tell him all he wants, but there is only one leader, and
Decider-in-chief.
That leader does not care about. Well, he may care about a market collapse, but he doesn't care that the Fed is independent. He believes he's the boss.
Well, to that end, is it rare for the Secretary of Treasury to actually weigh in on interest rate policy from that position?
Well, of course it is. It hasn't been done in decades. I mean, we got officially into the government doesn't, the executive branch doesn't comment on the Fed during the Clinton administration under Bob Rubin, and it's been that way pretty much ever since. But
until first Trump term.
But this is not the usual presidency. This is Donald Trump's presidency, and it is completely different from anything we have seen before.
Eric, forgive, 35 seconds. Scott Besant passed on being Fed chair, right? That's at least what we've reported. Mm-hmm. Do you think he understands the importance of an independent Fed, how important it is globally?
Yes, he talks about it being a jewel box. And by the way, the reason he passed on being a Fed chair is because he finds the job that he's got now way more interesting.
Head of the IRS?
I think he thinks of the job of federal the Federal Reserve Chairman, particularly if all you're really supposed to be doing is setting interest rates, as relatively speaking, very one-dimensional.
Great stuff. Guys, thank you so much. So appreciate. Eric Schatzker, editorial director of Bloomberg New Economy, editor-at-large for Bloomberg Businessweek. Michael McKee, international economics and policy correspondent at Bloomberg TV. Check out the full Bessent interview, Secretary Bessent. It's on the Bloomberg.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
We got a lot of economic news this week. Reads on U.S. inflation, one perceived as better, one not so much. We also got some data on factories. And we got a check on the all-important U.S. consumer and retail sales.
I was out that day. I was not shopping. I was not contributing to the economy. I guess I was contributing thanks to being on vacation. Yeah, I'm always contributing to the economy, to be honest. Carol, you and Emily Griffeo caught up with someone who's been analyzing the retail space for a long time. She's just a real legend within the industry. She broke down the data. She looked more broadly at what's hot and what's not among the nation's retailers.
Let's ask Dana Telsey. She knows retail like no other. She is founder, CEO, and chief research officer of Telsey Advisory Group. She's with us in New York City. Dana, thank you so much for joining us on this Friday. When CEOs are talking about the economy, do they always kind of talk about it, or do you feel like we're seeing more momentum around some of those earnings releases about concerns about the consumer and the economy?
Thank you for having me. And yes, I agree with your take. You're definitely hearing more commentary that continues to be increasing quarter to quarter about the uncertainty of the economy. What you've heard from CEOs this week and a little bit last week, and we'll have a lot more next week, is that spending and sales since the end of the June quarter has improved and it's increased. Some of this may be because the pull forward of sales, given the price increases from tariffs, are not yet fully there. And you've also heard the volatility. For example, maybe like April and May was weak, but then June and July picked up. And is the new normal going to be volatility and then improvement, volatility and then improvement? The lack of consistency makes it difficult for C-level executives to plan their businesses and give guidance.
But help us understand, I mean, it's been a couple months since Liberation Day. We've been dealing with tariffs. Is all of this uncertainty still linked to consumers just looking at tariffs, businesses looking at tariffs, and still not understanding exactly how those are going to affect their businesses?
Well, there's a couple things. First of all, what you're seeing companies do is they're diversifying their sourcing. And as they're diversifying their sourcing, many of them pulled out of China, went other places. The tariff rate went higher than China, and now some of them are bringing back their sourcing to China. Second thing is we do a tracker of 80 items each week that we price. We've been doing this since April 16th. And one of the things you're seeing is our pricing, and they're iconic goods, whether a Levi's 501 jean or a Barbie doll. You've been seeing prices begin to go up. Certainly on footwear, we've seen that, and we expect it to continue to increase going forward. You had Amazon Prime Day this year, 4 days instead of 2 days. And the first 2 days versus last year were up double digits. So consumers are taking advantage of deals that they may think they're getting now, coupled with newness in product like closed-toed Birkenstocks, where they're buying some of the new items that they wouldn't have had before and were just introduced, that's capturing the interest of a younger consumer. So there's a mix of things that are going on to create this dynamic of what's happening to sales.
Dana, so the retail sales numbers, again, it's an interesting number, and it could be that people are just paying higher prices for everything. Would you say in a nutshell, if you kind of roll in the U.S. consumer sentiment feelings, down for the first time since April, they're concerned about inflation, consumers are, that the U.S. consumer is largely cautious?
Yes, they are. They're more discerning and cautious consumer. They're more selective in their spending. And you're seeing it whether it's in restaurants, you're seeing it in some travel, and you're seeing it in the purchase of goods. More to come this upcoming week, given that Target, Walmart, all reporting their results, and Estee Lauder. So more to come in dissecting what it looks like.
Dana, I have to get your thoughts on the Tapestry earnings that we saw just earlier this week. What did you make of kind of that divergence in their two businesses? The Coach brand has been so popular with Gen Z. It feels like everyone wants to buy a Coach bag now, but the Kate Spade brand really pulling back. Just walk us through high-level thoughts there on what you made of those earnings.
When you think of Tapestry, it's a portfolio company with two brands, like you said, Coach and also Kate Spade. The Coach brand up double digits. The Coach brand seeing average unit retail selling prices increase, capturing more new customers and going from strength to strength by adding items in their collections that allow them to have a consistent and sustainable business model. The Kate Spade brand is only 15% of sales. More of their goods are sold in the United States, making them more impactful to tariffs. And that was definitely one of the headwinds. And they have to set the transformation. The surprise was they lost money in the quarter. There's a reset going on. It's taking longer than expected. You're going to have this upcoming fiscal year where you're going to need to see stabilization markers of what the brand is, while they also try to lean into the Coach playbook and utilize some of those learnings to update and improve Kate Spade. More to come, but 85% of the business is Coach, and that's growing.
All right. In terms of earnings, just one last question, 30 seconds. What's the big one next week?
It's going to be Walmart and Target. Is Target going to talk about a successor? Is Walmart still seeing growth in food? And they seem to be the market share gainer at Walmart.
All right, going to leave it there. Dana, thank you so much. Dana Telsey, CEO and Chief Research Officer of Telsey Advisory Group, joining us in New York City.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Well, we've been talking a lot about rare earth minerals as of late, and some of the U.S. companies that are manufacturing. The White House, too, has been talking a lot about this.
Yeah, we've talked recently to the CEOs of MP Materials and USA Rare Earths. Those are among the biggest U.S. rare earth mining companies in the U.S., but it's not just rare earths that matter to the U.S., and that brings us to one small cap miner with a roughly $500 million market cap.
The company, United States Antimony, and though it's not a household name, it's in the crosshairs of U.S.-China tensions and the global race for key minerals.
We spoke with Gary Evans, chairman and CEO of United States Antimony Corporation, who joined us alongside Bloomberg News economic statecraft reporter Joe Doe. And during our conversation, we noticed shares of the company were rallying.
We're in the category of critical minerals. There's critical minerals and there's rare earths. And so the public really needs to understand there's a significant distinction. Critical minerals, as an antimony producer, we're number one on the DOD's critical mineral list. And the problem is there is no antimony today being mined in either the United States or Canada. It all has to come from international sources. We were all getting, every country in the world was getting most of their antimony from China. China controls 65% of world antimony ore, the raw ore in the ground, and they control 85% of the downstream processing, which is what we do. So fortunately, we're in a position of having a smelter in Montana and one in Mexico, which makes us the only two operating smelters for antimony in North America. And therefore, as you said earlier, we're getting a lot of attention from the U.S. government. They want us to expand our operation. I think I read a report in April. We only have like a 5% supply in our stockpile. So we're trying to ramp up our business to meet this critical need. And as Joe said, there's no question that antimony is needed by the military. It's used predominantly, as he said, in bullets, but it's also used in laser-guided missile, night vision cameras, night vision binoculars, and what have you. So it's a very necessary element for the military.
Hey, Joe Doe, come on back in here. We heard from Gary just now that the antimony mining is not done here in the U.S. or in Canada. Is it possible to do it here in the U.S.? Do we have the material to mine it? It's just not done for environmental reasons. It's not done because we don't have the mineral rights to it, or the companies don't have the mineral rights to it. Like, why has this been moved to China? I understand from a processing perspective why that's happened with rare earths.
Yeah.
But with a critical mineral like antimony, why is that not happening here?
Well, I mean, I think you go to deposits, you know, how good is the deposit, and you can pull it out of the ground, and then who can process it? And this is a question that I have talked about now quite a bit with Gary over the last few months. And, you know, Gary, I think you're better positioned to talk about that to an investor class. I mean, you know, you talked to your investors yesterday on your earnings call, and they asked you about the potential of beginning mining in the United States anytime soon. And you effectively told them probably it's not going to happen anytime soon. So where is kind of the upside here?
We've been working on acquiring leases in both Montana and Alaska. We've acquired close to 30,000 acres of property in Alaska, and we've taken over the mountain area where our smelter is. It used to be an area that we mined some 20 years ago. So it's coming. Right now, we're held up by permitting. We filed permits in Alaska back in May. And so getting back to your question, why isn't this being done? The EPA, the federal government, whether it be the Forest Service, the BLM, native tribes, everybody tried to stop mining in the United States. And unfortunately, our laws allowed that. And that's why you see mining occurring all over the world except the U.S. It's coming back. And there's no doubt this administration is very pro-mining. And we have the resources. There's no question that we can meet the demand for the United States with just our Alaska properties. We have no doubt about that. And that's going to happen soon. I would think in the next 30 days, we'll be able to bring our first loads of antimony truck from Alaska to our facility in Thompson Falls, Montana.
Gary, how would you describe the conversations now with members of the Trump administration with this government versus your conversations during the Biden administration? How are they different?
Well, we started talking to the Department of Defense back last September. This was right when China banned all antimony sales to any country in the world. And of course, our Department of Defense was getting all their antimony from China. So it raised a lot of red flags. And we've been negotiating various agreements and contracts with the Department of Defense and the DLA since that period of time. As we mentioned on the call yesterday, we're very close, we think, to announcing some things. It's not done yet. But there's definitely a mindset change addressing your question from the Biden administration to the Trump administration. For instance, we'll have to respond to a request from the DOD, and they say, can you have it to us by Friday? We give it to them Friday at 5 o'clock, and by 8:30 Monday morning, we have a red line response. It's not very often you see the government working over the weekend. So there's no question this is a high ticket item with our existing administration, and there's a fire been lit.
Gary, despite the fact that you're getting a lot more attention from the Trump administration and they seem to be speeding things up, I'd still ask, what is the holdup? And I know this was a big question you got on the call yesterday with investors. They kind of seem to be saying, when are you going to get some sort of announcement from the government? What's going on?
We're in a period where contractual changes are being made. There was an open comment period with respect to the DLA that ended actually yesterday afternoon. So I'm very confident we're near the finish line, but it has taken an inordinate amount of time. And there's been a lot of reasons that I can't really talk about today for that delay. But we have to make sure that whatever contract or whatever agreement we sign with the government is beneficial to our shareholders. In the first drafts, we're not. And so we had to make sure that we negotiated as best we could to maximize the value for our shareholders, but also give the federal government a fair trade. We pay taxes, we know, and so that was very necessary.
Forgive me if I missed this, but is the agreement that you might be working out with the government akin to what we saw with MP Materials, which has a $400 million equity investment by the Department of Defense into the company? And we know that MP Materials is certainly working specifically in the rare earths materials area. So could it possibly be that the government, DOD, makes an equity investment in you guys as part of an agreement so that you can do what you need to in terms of ramping up either production or your facilities? So
obviously that's on the table, I think, with us as well as a lot of other companies. I think we're in a little bit unique position in that we have a $450 million market cap. We have our own cash. We have our own capital. We need, more of a big brother than a huge capital investment. Now, as we ramp up this year and do the things that we've told the public we plan on doing and the DOD, I think there's a very good chance in 2026, if we want to do another smelter, if we want to do another project, we also are involved in tungsten and cobalt, two other critical minerals, then those type of opportunities exist. But what we're negotiating today and have been for the last 8 months is something different. It's very positive for our company, but it's not a direct investment by the government.
Gary, I want to kind of bring people into what's at stake here, or at least what is being said is at stake. As you mentioned, the Chinese officials put an export control on antimony, which came well after the germanium and gallium that so many people talked about a couple years ago. Have you guys experienced any of these effects of export controls on antimony from China?
Yes, unfortunately, we have. We were acquiring material from a company out of Australia, and we were taking that material. There are 55-ton container loads to our smelter in Madero, Mexico. And that particular, this third load that we had acquired was transloaded over in China in April. And the Chinese customs confiscated our container, took it off the ship, and held it for 90 days. Gave us no reason. All the paperwork was correct. It had been paid for. And we finally had to get the State Department and the White House involved. For some reason, finally they released it. It showed back up in Australia, did not come to us. They sent it back to Australia, arrived there about 3 or 4 days ago. It's currently on a ship to Mexico now. So from now on, obviously, whoever we buy antimony from, we're putting under contracts. They cannot stop in China because China did this for whatever reason. We know this company used to sell antimony to China. Maybe they were mad. The fact that it said U.S. antimony on it maybe ticked them off. I don't know. But they definitely made a statement with what they did.
We're speaking with Gary Evans, Chairman and CEO of United States Antimony Corp. Also with us, U.S. economic statecraft reporter Joe Doe.
Gary, a follow-up on that. I mean, what does this really say? I should people actually be concerned? I mean, eventually your antimony is getting to you here at your Mexico location. Are we sounding too many alarm bells on this front?
I don't think so. I doubt in our lifetimes we'll ever see antimony coming out of China again. We know their largest mine was depleted last year.
Ever?
And so, ever. I don't think we'll ever see antimony coming out of China. There is truly a worldwide shortage of this product. It is so difficult for us to find product. That's why we went and started mining it ourselves. There's just not any supply.
Presidents love to talk about energy independence. It doesn't matter if they're Democrats or Republicans. Do we get to a point where they can talk about antimony independence and we can get 100% of what the U.S. needs from U.S. supplies?
I have no doubt that we can meet all the needs of our government as well as our industrial customers from Canada, the United States, and Mexico. We don't need to go anywhere else.
When will we be able to do that?
In the next 3 to 5 years. It's not going to happen overnight.
You know, in the last few years, you would have said Canada, United States, and Mexico, and I would have thought, okay, that could work. These countries can all work together. But over the last few months, we've seen trade tensions flare, especially with our neighbors to the north and our neighbors to the south. How does that affect the way you look at the industry and your own business?
No question that, Mexico has a new president. She's very anti-mining. Fortunately, the mines that we have in Mexico are grandfathered, but there needs to be greater collaboration. Now, the DOD looks at Canada just like it was the United States. So any project we find up there, the DOD likes it and looks at it as a domiciled country.
Yeah, wait, is that as a separate country or because they want to take it over?
Well, the 51st state, of course, is what I'm talking about.
No, I'm just... So you're saying relations between the two nations are comfortable, and despite what we have in the headlines, you're saying that they are working and cooperating because they understand they kind of need each other.
Yeah, well, Canada needs antimony just as bad as the United States needs antimony, and Canada is a very pro-mining country. So that's why we have a lot of activities, like I mentioned, in tungsten and cobalt in Canada.
Gary, these conversations you have with defense officials, how dire are they indicating to you that the antimony shortage is for them?
When you see the announcements we'll be making, you'll understand it's pretty dire.
Can you give us?
We have the lowest. Yeah. We have the lowest amount of antimony supplies in the inventory for our government since World War II. You got to remember, we're funding Israel, we're funding Ukraine, and we've dwindled our supplies. And at the same time, China cut us off. So it's a double-edged sword. People are waking up that, hey, we have a problem.
So what does that mean for national defense? Like, what would your message be to viewers and listeners right now about how critical this mineral is?
It's an extremely critical mineral, and there's people that have tried to replicate antimony with other synthetic antimony, and it hasn't worked very well at all. In fact, it's 3 times expensive. I do think there'll be continued upward pressure on the price because we can't come close to meet our customers' demands. We're changing that.
Yeah.
We have a substantial expansion going on in Montana that'll be done by the end of the year, but it's just going to take some time. It's not going to happen overnight. It's not like there's a huge pile of antimony sitting over here in some country waiting to go to market. It's all depleted. So we're having to find new areas to find the ore.
Gary, how long has the dwindling supply issue been going on for? And I'm just curious if you had conversations with the Biden administration as well.
Well, because China was selling so much antimony around the world, nobody cared about it. China kept the price artificially low, less than $5 a pound. Today, the price is $25 to $27 a pound, and probably going higher. I really believe we'll see $50 a pound in the next year. So, the fact that we were so dependent upon China and had blindfolds on that all of a sudden they cut it off had nothing to do with Trump coming in office. This happened last September. So it's been a year since they cut everybody off. It's not just the United States. They cut off every country in the world, the European Union, all other countries that were buying antimony. You can sell antimony to China, but you get nothing back in return other than cash.
Gary, what's the biggest hurdle U.S. antimony faces right now in getting more antimony production up and out the door?
If I had my permits right now in Alaska and in Montana, I'd have antimony in our smelters. I don't have those permits yet. And, we're doing everything we can to speed it along. There's people in Alaska that don't want to see mining, and there's a group called Save Our Domes. We've done PR work. We're doing everything we can to grease the skids to make sure that people understand that we're trying to clean up. This is antimony left on the ground the last 100 years from gold miners in Alaska. We're picking it up, putting it in super sacks, and bringing it to Montana. We're cleaning up the place, and people are fighting that. So it's an education process. So we've got a lot of PR we're doing, and we're obviously working with senators, House members. We're working with the president. We're working with a lot of people. You'll see some other news about that next week.
Gary, would the Defense Department be your only customer?
We currently have 17 industrial customers. We have one particular customer that would take 100% of our supply. So that gives you an idea. The industrial side is much greater than the Department of Defense. And that's, one thing in these contracts we've been working on. They've made sure that we don't take away the business from the industrial side. And that's why we're ramping up, because the government needs a stockpile, which they currently don't have. And we're the only provider. There's nobody else. It's China. It's U.S. antimony and a smelter in Belgium. That's it for the whole world.
All right. We're going to have to leave it there. I got to say, this is one of those interviews. I know Joe knows this stuff, but I certainly take a lot away from it. Great. Gary, thank you so much. Gary Evans, Chairman and CEO of U.S. Antimony, joining us from our bureau in Dallas. And, of course, our in-house expert on all things when it comes to mining, Bloomberg News economic statecraft reporter Joe Doe. By the way, shares of U.S. Antimony, Tim, they're up about 117% year to date.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including a check on the New York City luxury real estate market, who's buying and who's paying in cash.
Plus, the most stunning and rare cars from around the world are taking center stage at this year's Pebble Beach Concours d'Elegance. We talk with the chairman, Sandra Button.
First up this hour, green firms in the United States have found something of a lifeline in artificial intelligence after being bogged down by high interest rates, shrinking funding, and more recently, President Trump's sharp rollback of support.
Our Bloomberg New Energy Finance team recently pointed out that clean tech companies that have inked deals to support data centers have seen their stocks soar this year, outperforming the S&P 500. That includes the stock price of fuel cell provider Bloom Energy, which, as we put our show to bed this week, nearly doubled so far this year and has a roughly $10 billion market cap.
And shares of Bloom Energy continue to rally big time again this week. K.R. Schroeder is founder, chairman, and CEO of Bloom Energy. He joined Bloomberg's David Gura and me to discuss the impact of AI on its business and a lot more.
This is an amazing time in human history where we have not seen the need for power growth anywhere close to what we are seeing today. Let me put it in perspective. The amount of power that the big hyperscalers are saying they need between now and 2030 is equal to all the power every single family home in the US put together would need. There are about 85 million single family homes, give or take. All the power that they use is going to be needed in addition to the power we have today to just power the AI data centers. That's how large this opportunity is. And very clearly, the old model of centralized power plants with transmission distribution simply cannot meet that demand in a timely fashion. That is the opportunity, and Bloom was purpose-built to provide on-site power for the digital revolution, and we are so happy to be in the right place at the right time.
Well, help us understand how the company works, and you mentioned that on-site power, sort of what that looks like. Of course, there's been so much conversation in recent months about perhaps the need to invest more in nuclear power or fortify the grid, bring more power plants online. How do you see your company as maybe not a substitution for that, but a complement to the kind of growth and development we're likely to see here in the power grid going forward?
I think we're going to need all forms of power in very large quantities going forward to meet our voracious, like energy needs. However, in the short term, if you take 5 to 10 years, natural gas to electricity is going to be the single largest contributor to this additionality. What Bloom does is takes natural gas without burning it, without combustion. We extract the chemical energy in it using a fuel cell and make electricity at the highest efficiency, without air pollution, without noise in our generators because they're quiet, solid state, and with very high reliability. For those reasons, if you are in a neighborhood that is going to have a data center, we are your best choice because we don't pollute your air, we don't use water, and we don't make any noise as we generate this reliable power. So you can have the economic advantage that a data center brings to the local community. At the same time, you're not compromising on your health.
So one thing I want to ask you, actually, our Will Wade does, who really covers this space. And we were talking about you coming on, and he said, well, wait a minute, let's talk about these fuel cells for data centers. Can fuel cells really work for this? What evidence have you guys seen that it does really work?
So, yeah, that's a great question. The issue is we are progressing so fast in our technology at AI speed that some people that have looked at fuel cells 10 years ago and have that notion of who we are don't understand where we are today as a company. We already are powering more than 0.5 gigawatt worth of data center because our total installed capacity for data centers is more than 0.5 gigawatt. So we're not a concept. We are not a PowerPoint. We're actually producing power for these data centers. And this year alone, we have increased our capacity to 1 gigawatt a year. And we announced in our earnings call that by end of next year, we can do 2 gigawatts a year. That's 2 nuclear power plants worth of power coming out of our factory next year. And you know how long it takes to build a nuclear power plant and actually commission it. So we are no longer a concept. We are a mature technology that is affordable and can compete with other technologies that don't have as good attributes as we do.
Sridhar, I wonder if you could talk a bit about your business model. I know that you've announced deals with other companies, most recently with Oracle, of course, a company that I know is investing a lot in its data center infrastructure. Could you, K.R. Sridhar, just give us a sense here sort of what those deals look like, what that deal with Oracle is like in particular?
Yeah, David, so our customers, here's what happens. Once we sign a deal with a customer, they either buy the capital equipment from us And then they also sign up for a service contract. It's a 100% attached rate because we run those units for them and we maintain that and we offer them the promise guarantee of performance. Now, if they don't buy the equipment as CapEx, we create a special purpose vehicle using financing and we simply sell them power just like the utility would, except this is on-site and highly reliable and clean. So either way, when we create a special purpose vehicle, that financial investor in that vehicle gives us the upfront money for our capital, and we also have an annuity revenue coming out of service. So we have two streams of revenue, if you want to think about it. Installed capital equipment that gets paid to us when we ship the equipment, a continuous service annuity over the tenure of the contract. That's how we make our money, irrespective of whether the customer actually buys the capital equipment or a third party buys the capital equipment and then charges the monthly rate from the customer.
Hey, KR, I'm curious. I'm looking at one of my favorite functions on the Bloomberg. It's the supply chain function. And I'm looking at your customers. Your biggest is, I think, American Electric Power Company. But I'm also looking at Alphabet, Microsoft, sound familiar. These are some of the hyperscalers. Tell me how they are amping up their business, because they're the ones who are doing the massive AI spend. But it looks like they're a very small part of your business. I'm just curious about what's the conversations you're having with them. Are they ramping up to do more with you? That would be very telling.
Yes, the answer to your question is very simple. In the past, these hyperscalers would spend all their capital equipment just on building the data centers, and they could simply pick up the phone and call the utility company and they would provide the power. No longer is that a reality because the utility does not have the amounts of power that these hyperscalers need. So now, electricity, power, which is what ultimately the data center needs to monetize the data center, is a supply chain that comes from the common good called the utility. So they have to own that supply chain or they have to procure from that supply chain.
Right.
We are very much an integral part of that supply chain, and we are having conversations with all the hyperscalers today. And you've seen the announcement at Oracle. Expect to see similar things coming soon. Our American Electric Power contract was actually for AWS, which is another hyperscaler.
I wonder if you could situate your company and this industry in the moment that we're in. So we're coming out of an administration that was doing a lot to support or encourage the adoption of alternative energy. Suffice to say, this is an administration that's not doing that. There's much less impulse to do that going forward here. What do you see here as the ideal role of government in encouraging the adoption of technologies like yours? In other words, if you'd like to see fuel cell technology take off, be more widely adopted, what is the role of government in making that happen, if any?
I think a simple role that they can play going forward is the U.S. government, between the various government functions, the military and the intelligence, is the largest procurer of electricity. To be able to purchase electricity from technologies that are made in America. We are a made in America technology. No other country in the world has the technology that we have. So they should embrace us and they should give us an opportunity to serve the U.S. government, the U.S. military and U.S. intelligence and make us a really strong country.
One thing I was also curious about, and I'm looking at your market cap, it's almost about $9.6 billion. And it is this excitement over AI. There's all the money that's being spent, KR, on the build out, and I get that. But I'm just curious, then there's going to be the maintenance, and we might not need as many workers. And, we're all trying to get our head around whether, the boom, the bust part of maybe AI. After the build out, what is the business for you? Is it maintenance? Is it replacement values? I'm just curious.
Thank you for asking that question, Carol. The build out is just the tip of the iceberg. Why would these large hyperscalers spend close to $1 trillion worth of CapEx just this year alone if all that they're going to do is that build out? That's the training data centers. The inference data centers will be at least an order of magnitude larger than these training data centers, which are the foundation building blocks. Every factory, every bank, every law firm, they're going to have inference data centers close to the edge. And these edge data centers are going to be located where you all live, where people are, where equipment is. And in those congested cities, getting the additional power needed, 10 to 20 megawatts in every edge data center, which is an inference data center, we are ideally suited not just for the large data centers, but for these edge data centers, because we are non-polluting, we are quiet, we are reliable, and we can provide it on site very quickly. So we are super excited about what we think is a really secular phenomenon that's happening here that's going to last for a very long time to come. This is not just a build and bust cycle at all, as far as we see.
So when you say a long time, are you saying decades, or I'm just curious?
At least a couple decades. At least a couple decades.
All right. Good to know. We'll stay in touch. Love to hear, because you certainly have a front row seat in terms of this spend and what is going on. Certainly all the power that's needed. It's just kind of astounding. Dr. K.R. Sridhar, he is founder, chairman, and chief executive officer of Bloom Energy. The stock, David, up another 9% in today's session, and it's really been on a tear this year, up about 84%.
So interesting to talk about these companies because we focus so much on the AI providers, those who are making these chatbots and all the developments there. But as we were just discussing, the apparatus that you need to make all of that work, so huge, so sprawling, and I'm just fascinated every time I kind of learn what goes into that, making all of this stuff run.
Right. We just hear about that kind of the big hyperscalers and their spend,
stuff,
but there's a lot of stuff that needs to be done.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App, or watch us live on YouTube.
Let's talk real estate, because our Bloomberg News team reported that Manhattan home sales in the second quarter were stronger than they've been in almost 2 years, boosted by cash buyers who've been undeterred by the economic uncertainty created by President Trump's trade war. We got some numbers here. A little more than 3,000 co-op and condo purchases closed during the quarter. That's a 17% jump from a year earlier. That's according to Miller Samuel and the brokerage Doug Elliman. The median price of those transactions, $1.2 million. That's up 1.6%.
I love this. Cash buyers. All right. So we're wondering what Louise Phillips Forbes is seeing. She's a real estate broker with Brown Harris Stevens. She's been in the industry for more than 3 decades. We love kind of picking her brain about what's going on. She's got close to $6 billion in sales during her tenure. She's back with us here in our Bloomberg Interactive Broker studio. Hello.
Hi. Good to see you guys.
Good to see you. So where are we? Give us a snapshot of the market right now.
You know, you just did that little snapshot of the quarter. I did a little snapshot from May and June for 2024 compared to 2025. And there was a 72% volume and price sales. So it went from 1.4 billion in sales to 2.4 billion.
So
of contract
almost a doubling.
signs. Almost. And then you also had a 25% on the number of transactions. This is all 4 million and above. And on an average of those 2 months in 2024, they were 8.2 million. This year, they're 11 million. So, you know, chaos is opportunity for many. And cash on those deals is 90%. That's a lot. So it's kind of interesting. I mean, I talk to my bankers all the time, and they are busy. They are busy, but on the lower end, and people are closing with cash, and then they're pulling out, you know, cash back.
Okay.
We spoke to Peter Ockerbloom, Chief Revenue Officer at Sentient Jet, the day that FlexJet announced this, another private jet firm that owned by the same parent company, announced this investment. And they basically said, we're seeing wealthy people from tech and crypto, younger people from tech and crypto want private jets. We're seeing our demographic go younger, and we're seeing crypto and tech people.
That doesn't surprise me.
Is that happening to you?
I think that the assets, first of all, let's just kind of bring it down for 1 second and remember that the first-time buyer today on an average is pushing 40 years old. That's different from that millennial run that we had in the construction boom. But on
even in New York, right?
Even in New York.
Yeah. Okay.
Particularly in New York, to be honest. And I'm seeing more and more first-time buyers that are purchasing that are having family members, multi-generational family members, like grandmothers, like instead of inheriting this, I'm giving it to you, or I'll co-purchase with you with the right to survive. So Listen, creativity we're in Mecca, so people are going to be creative to buy a piece of the rock. And I do think the, new money, and I've seen it, watch the tech commitment from the first announcement of Google in 2005 with like 48 employees morphed to 500 to 2,500. And you see that we are now becoming a hub for tech. And as you run up against the housing issues that are in California, we're attractive. We can get insurance for our apartments.
Do we stay attractive even if Zohran Mamdani wins the mayoral race?
You mean
next
our
year?
Robin Hood? The Robin Hood rhetoric? Listen, I know this person cares about New Yorkers. I believe that. I believe wholeheartedly that his intentions are stellar. But, the ideology around real estate is not a conversation. It's action, it's infrastructure, it's collaboration, public-private. And, we just crawled out of 5 years of COVID. We now have 64 million last year in tourism. The crime is down. You have people back in the office. So freezing rent is doing nothing. And it's also suggesting that landlords are all on their yachts doing nothing and that they should be paying for the opportunity for somebody else to be able to pay rent. But there's so many landlords that are just skinning by because they were postponed from allowing people who weren't paying rent.
So, Louise, Tim and I talk about this a lot. And I feel like when we have real estate discussions and the idea of providing affordable homes in kind of major cities where a lot of people work so that you don't have individuals who are maybe not making that much money having to travel an hour or two in order to work. So what's, because I've been talking about this like my whole career.
Yeah.
How, this industry, how do we do this so that there is affordable homes in the places where people are working?
When I came into the business, they had something called 421As. They were certificates that when you improve a land, there's an unimproved land. And remember, Bloomberg, thank you, 12 years of, rezoning, probably 40% of our land mass, which has helped that situation. And when you build in the middle of, they used to have these tax certificates that when developers would improve land, they would get a 421A tax abatement. It's a 10-year abatement on your taxes. And then for that certificate, they would then go and sell it for somebody to do affordable housing somewhere else. That has gone away. Now,
was that affordable house though still in New York City?
Yes.
Oh,
yes.
Okay.
And by the way, people would say we don't want to just be in the Bronx and in, far parts of Brooklyn or Queens, but honestly,
and nothing wrong with those parts, but you want a mixture. Yeah,
and
you want a mixture.
And I just think that it has to be thoughtful and it has to be collaborative, and it can't be just somebody who isn't practically experiencing these things making rules up, like the city councilman that has good intentions around broker fees. Well, rentals as of June 11th are up 15%. Because they've just passed it all off to the consumer. And so unintentional consequences when lawmakers don't want to collaborate with the industry individuals, as well as just regular people, if it's only politicians making these decisions and not working with their people.
I think there's always a concern, though, that the people who are renting don't have the voice and don't have a seat at the table.
Agree, but you know what I mean? Remember that New York City is 68%. It's a city of renters.
Yeah.
I want to get to know your clients a little bit and how they're different than they were, let's say, a year ago. The people who are selling real estate with you right now, why are they selling and where are they moving?
A lot of it is life change, but I have people that have been contemplating selling since 2020 that are now selling because there's a lack of inventory. What their apartments were not worth in 2023 are worth what they would like, and they'll accept it. So, look, a lot of people are downsizing and staying in the city. They are people that are leaving, but that's a life decision that is, a cycle of life. I have a lot of people coming back into the city because their grandkids and their kids are here. So who are my sellers? My sellers range from like a 1-bedroom for $650,000 to, and that's somebody who bought, who now is leaving the city and loved owning her home, and she's ready for a new chapter in Colorado. And then you have a $16 million penthouse, which is from one of my developers that will be coming on the market in September on the Upper West Side. And I just think there's just not enough inventory. Inventory is 21% down. And that is the first time we've experienced that since COVID as well.
It's amazing because sometimes it feels like there's a ton of building and stuff going on. Hey, before you go, we've got a minute and a half left. Tell us about what you're seeing in terms of international purchases.
They're coming. They're coming, and it's doubled since 2024, particularly the Chinese market. I mean, when you are dealing with strife in your government and the housing market in Beijing is kind of upside down. I'm not familiar with that market particularly, but in all of the appointments that I've had in all the various condominiums, they are buying. Some of them are buying with the anticipation of their children in the future to be going to school here.
Where are they buying?
All over, but new developments particularly. And that
Manhattan?
has always been in Manhattan, Brooklyn, Long Island City. We were talking earlier about there are some developers that are leaning into the Asian market by accepting deposits that are in the Chinese
Yuan.
the yuan.
Yeah.
And that is because they are being nimble. We have to be nimble.
But that's new.
That's relatively new. There are 2 projects in particular. One is in Long Island City, and this was news for me, a couple months ago.
Russian buyers gone?
Yeah, no, quiet.
Coming back?
Quietly trying to acquire or displace, place assets, but not as big as what we experienced when you had the 88 million 15 Central Park West transaction.
It's not like that anymore. Middle Eastern?
Not quite.
Middle Eastern buyers?
Yep. And you have also, I have had 3 different Korean transactions this year. I think they're quiet. French. I mean, I think people are trying to come here. There's jargon around the Canadians not being happy. And
if President Trump does away with the capital gains tax on house sales, what would that mean? And just got 25
Just
seconds.
to remind everybody, when Bush was in the House in 2012, and he reduced the capital gains to fuel our market went on fire in 12 and 13. Just for that was like the people that lived on Park Avenue and Fifth Avenue for 4 decades finally sold.
I can only imagine. Louise Phillips Forbes, always fun to check in with you. Be well, be well. Real estate broker Brown Harris Stevens joining us in our Bloomberg Interactive Broker Studio. This is Bloomberg.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This weekend wraps up the finale of Monterey Car Week, where the California coast becomes the ultimate showroom for some of the world's most extraordinary automobiles and car enthusiasts.
It ends with their annual event, the Pebble Beach Concours d'Elegance. Sandra Button knows about this event pretty much better than anyone else. She's the longtime chair of the Pebble Beach Concours. She previews what makes this year's show so special and gives a look into the collector car market.
The collector car market is really celebrated on this one day a year at Pebble Beach, when it's sort of like the Olympics of cars, and it's a whole symphony of different kinds of cars, from cars from the late 1880s all the way to Formula One cars that were just raced this last season. So we really all things cars and everything in between. And of course, you mentioned the beautiful cars from the 30s and the swoopy lines. Well, it's all going to be here.
So how does a car get invited to the show? Because is it that the car gets invited, not necessarily the owners?
It's all about the cars. And, because we have about 250 cars on the field. And if you own a car that's really important, and let's say it's a part of our celebration this year, we're celebrating 100 years of Chrysler. We have Invictas, Moretti's, believe it or not, 100 years of the Rolls-Royce Phantom, just that one mark of car. So if you own one of those cars and it's critical that we have it, that it's important to celebrate, that's one way to get invited.
Hey, I want to ask a little bit more too about, judging and how it all works. But I want to take a step back, Sandra, because this is something that has been around for a long time, started back in 1950. And I'm just curious why and how it came to be one of the most important and prestigious car shows really in the world.
Something that I think is really cool about the Pebble Beach Concours is that we're actually very dynamically organic. The event started in 1950, and to be honest, the Pebble Beach Concours was just a sideshow. The Pebble Beach road races that started in 1950, they were the star event. And after the road races finished, then it was kind of time to kick tires and take a look at cars. And in the very beginning at Pebble Beach, the cars were brand new. They were sports cars, from the 50s. And that kind of changed in 1955 when Phil Hill won with the Pierce Arrow with an actual, antique car and not a brand new car. But Pebble Beach is all about celebrating everything automotive, racing, the style, even fashion. So I'm glad you got to see it once.
It was amazing. I have to say the whole event, you're just driving around the area and there's parades through the streets and it's just really, really beautiful and really amazing.
Sandra, I'm curious, how in general has the collector's market been right now? Because typically it's been pretty volatile.
Well, I think you've mentioned it's been volatile. It's kind of like any art market. Of course, it has ups and downs. And I would say we're seeing some generational shift, that a lot of the people that collected the cars from the 20s, 30s, and 40s are aging out of the hobby, and we're getting newer collectors who are maybe looking for things that are more relevant to their lifestyle or cars that they've seen on the road. So yeah, there is that generational shift. There's also the challenge of getting these cars restored. Many of the people that have worked on the cars, they're aging out as well, and there aren't as many people joining the ranks of restorers. Hannah wrote a great article today about how a car gets ready for Pebble Beach, and you can see that there's not as many people joining that profession that are leaving. So it's a great job to look for right now.
Yeah, I agree with you. It's in our weekend edition for Bloomberg, and she says, she says that jobs, and she talks about one individual in particular, are the most tedious in the classic car business, which by its very nature tends to attract a select few maniacally devoted artisans. But we see that in general, like we talk about that, it's just not something we've seen certainly happening here in the United States. I love that you talked about, though, a younger generation. And it's another thing that we talk about, who's going to be collecting in the future. What does a younger generation of collectors, Sandra, mean for the winners of the concours? Could a 90s car win? Like, how does that evolve and impact?
You're right. Younger cars, that aren't as old can be winning. And we have runners up to Best of Show. So, we have 200 cars on the field. There's maybe 28 classes. So you have to win your class to be eligible for Best of Show. And of those 28 cars, it usually boils down to 3 or 4 that are all really in contention for Best of Show. So we bring up those runner-up, the nominees for Best of Show. And in the last few years, we've had post-war cars. Last year, we had a preservation car that hadn't been restored that actually became our winner. But you're right, the breadth of the years of those cars is widening. And I think it is because of the younger collectors that have so much passion. I mean, they really want perfection in their cars. They persevere through the restoration process, which can take years. And they really I think they're great stewards because they want the cars to be right for the future. So they dig into the history and they make sure that when they restore the car, that they do right by it, that they show the way that it was really built in the day.
We're talking with Sandra Button, chairman of the Pebble Beach Concours d'Elegance, joining us from Pebble Beach. I am curious too about the theme this year. My understanding is that you guys are marking 75 years of Formula One racing. So talk to us about this theme, how you're going to be celebrating it, and why you chose to pick that theme.
Well, I think 75 years is amazing.
A big one.
It's about the same age as the Pebble Beach Concours d'Elegance. But if you can think about, we're going to be able to see the entire history of Formula One unfold before us. And we're also having a class of Grand Prix race cars that predated Formula One. So you're really going to be able to see the entire history of racing along the water at Pebble Beach.
That's Sandra Button, chairman of the Pebble Beach Concours d'Elegance.
And Sandra came to us thanks to Bloomberg's Hannah Elliott, who's been right in the middle of all the action, Tim, at Pebble Beach.
She's walking the fairway, taking in the really cool rare cars, the crowds, and the excitement. Of course, we're talking about our car expert, Bloomberg News auto columnist, Hannah Elliott.
So this is a big year. It's the 74th year of the Pebble Beach Concours d'Elegance. This year, they are celebrating 75 years of Formula One. So the big thing on Sunday, which is when the main car show is they're going to have 30 old vintage classic Formula One cars on the lawn, which I don't think we've seen a big group that significant of F1 cars ever. So that's really the emphasis. We had the opening tour of the Concours, which is where all of the cars that are going to be shown on Sunday must complete a drive down the peninsula, down to Big Sur, across the bridge, and then come back. And that is to prove that they are running, driving cars. These aren't just, garage trailer queens. They can drive. I was fortunate enough to be able to drive in that as well. I drove in a modern car, but that was actually the really big kickoff to what we can look forward to on Sunday. And then, of course, we've got auctions, which is a really big too, selling similar, vintage and classic and collectible cars. Well, there's a lot going on.
Tell us about the collector car market. You were kind enough to link us up with Sandra Button, chairman of the Pebble Beach Concours d'Elegance. And we talked a lot about kind of the changing marketplace and maybe the interest or lack thereof, maybe among younger buyers. But it's evolving. Tell us about the marketplace right now.
It is evolving. Historically, this has been really a celebration of pre-war cars and cars from the 50s and 60s. And we are seeing that changing just because the people buying the cars are changing. It's coming into a new demographic. People who grew up with cars from the 80s and 90s and even the early 2000s, like Lamborghini Countaches, Ferrari F40s and F50s. We're talking about that kind of era of car becoming more popular in the auctions. And that has a trickle-down effect everywhere. So for instance, back to the Concours on Sunday, we have never seen a non-pre-war car win. But as Sandra kind of alluded to, I think we're moving toward that point. And the whole market is following that. Of course, you've got the Duesenbergs and the Packards and all of these really Rolls Royces, expensive multi-million-dollar pre-war cars. Those still exist. But there is a big upswell of these 90s and early 2000s Mercedes, Lamborghinis, Ferraris that are really coming on strong, and I think that's where the market's going.
I love that these are considered classic cars. Nothing, these are like cars.
Do you feel old?
Yes, I do feel old. Thank you very much. I mean, these are cars that I was reading, seeing on the cover of like Car and Driver and Road and Track when I was growing up. My dad had subscriptions to all of these things.
Completely. And these things tend to go in 30-year cycles.
Okay.
So that is sort of the general rule of thumb. Whatever you grew up with the poster on your wall, 30 years later, maybe you can afford it. Or maybe you can afford it.
Wait, so the car that I actually grew up, the like Driftwood Estate station wagon that was massive,
Yes.
That's a collector
We had one
car?
of those.
It was massive.
Yeah.
It was like, it just went on forever and ever.
Yeah,
we called
those
it the
were the
Driftwood.
Hey, before we let you go, who's going to work on these cars? You've got a great story out about the dwindling numbers of mechanics who work on classic cars. You have a classic car.
Yeah, I do. I've got an old Rolls Royce, and the man who looks after it is in his 80s, and I'm not joking. And that gets to your question. The people who work on these old classic cars tend to be on the older side. If you're talking to a teenager about spending hundreds of hours in a back room somewhere learning how to press metal, that doesn't necessarily sound as fun as some of the other job opportunities right now. So there is a big gap between the people who look after the cars and trying to get younger people involved in this trade. There are some colleges like McPherson College, which do have great restoration programs to teach younger people how to work on these cars, because at the end of the day, the love of the cars is going to stick around. The cars might change. We might go from pre-war to a Countach or a Gallardo, but it's still the car that needs to be worked on. So there's a gap right now, but there is some slow growth toward trying to get younger people involved. It's like if anyone thinks they want to learn a trade, this would be a good one to go into.
Our thanks to Hannah Elliott, Bloomberg News auto columnist. Check out Hannah's podcast. She co-hosts it with Matt Miller. It's called Hot Pursuit. And in the episode, they go into full detail of the cars that she saw at Pebble Beach. You can find it at Bloomberg.com/podcasts.
And that wraps up the weekend edition of Bloomberg Business Week from Bloomberg Radio. Thank you so much for joining us.
I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend, everyone.
This is the Bloomberg Business Week Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.